Stop staring at the green numbers. You are being distracted by the shine of a record high while the floor is quietly being pulled out from underneath you. There is one liquidity trap zone that will absolutely wreck late longs if triggered, and one hidden short squeeze opportunity that nobody is talking about. I'll show you both. Stay until the end because I'm giving you 3 exact entry and exit levels that you can use right now to navigate this precise inflection point on the S&P 500. The instant market verdict is that we are technically in a strong trending session, but we are fading in logic. The daily trend screams strong buy, the 4-hour and 60-minute charts agree, but we are trading directly into a massive structural resistance cluster. The session bias is a bullish breakout that is currently unconfirmed by the volatility index and market breadth. You need to write this number down because if we break it today, the whole structure shifts violently into the failure zone. That number is 73.56. If the S&P 500 loses 73.56, this record high chase immediately reverts to a bear trap. Above 73.56, the bullish trend is law. Below it, panic. Let's get into the technical deep dive. We don't just look at a price, we study the architecture of the liquidity. Starting with the weekly time frame, the picture looks almost too perfect. We have a sustained push above all major moving averages. The 20-week moving average is acting as a long-term propulsion engine far below current price. And the 60-week average has been sloping upward without a single moment of hesitation. But it's on the daily chart where we see the tension. The daily moving averages are compressing, and this is what most traders miss. While price is ripping to 74.44, the 20-day moving average is lagging significantly below us. This gap between price and the fast-moving average creates a rubber band effect. When you have a record closing high with a stretched price-to-moving average distance, you aren't looking at stability. You are looking at an energy coil that will snap back violently. The 200-day moving average isn't even in the conversation right now. We are completely untethered from the long-term mean. Drop down to the 4-hour chart, and this is where the trap is actually built. We are seeing a bullish MACD structure, but look closely at the histogram. Buyers are exhausted. The momentum bars are getting smaller on every new tick higher. This is classic negative divergence forming in real time. We are printing higher highs on price, but the 4-hour MACD is failing to print a higher high. This is not strength. This is the last gasp of a move that is running out of oxygen. On the 60-minute chart, the 20-period moving average is currently acting as dynamic support near the 7,430 zone, and price is clinging to it. As long as the 60-minute candles close above the 60-hour moving average, the aggressive algos stay long. But the second we lose that 60-hour anchor, the sell stops. Layer up like a cascading wall. Here is the technical truth. We have immediate structural support at 73.56. This is not just a random number. This is the prior breakout pivot and the volume-weighted anchor from the last 3 sessions. If we lose 73.56, the next gravity well is 7,311. That level is the true test of trend health. On the resistance side, 74.54 is the immediate ceiling, the gamma wall. Above that, we have 7,498. Which is the psychological magnet and the big figure barrier. I want you to visualize 7,454 as a brick wall. The market is pressing its face against it. If we break through 7,454 with volume, the shorts will get annihilated in a liquidation cascade. If we get rejected, the trap slams shut. Let's connect this to the fundamental driver and cross-linkage. Look at the news. S&P 500 and Nasdaq boosted by chips to a record closing high. This is the definition of a narrow, fragile rally. You are seeing a handful of semiconductor names masking the rotation out of everything else. This is a fundamental mirage. Why is it a mirage? Because we are seeing a massive divergence between the risk asset shadow and the liquidity tide. Bitcoin, our purest risk barometer, is not confirming this euphoria with the same structural aggression. When the S&P makes a record high, but the crypto-native speculative capital is hesitant, the equity move is being driven by passive closing prints and options flow, not genuine organic accumulation. This is an institutional gamma squeeze, not a value buy. Furthermore, The US dollar index is acting as the hidden antagonist here. The dollar stability is providing a temporary floor for equities, but bond yields are not lying. The cross-asset link between the S&P 500 and the bond market is screaming caution. If the dollar index breaks its short-term range to the upside, this equity pump reverses violently because liquidity gets vacuumed out. The 1 to 2 week directional lean is that we try to breach 74.98 to trigger the retail stops, but the failure probability at 74.54 is extremely high. The invalidation for my cautious thesis is a daily close above 7,500 on volume that exceeds a 20-day average. If we close above 7,500, we enter a blow-off top phase where the short thesis is dead. This is where the money is made. Most people will skip this, but this is where we turn the analysis into a plan. Keep watching. We are going to lay out 3 strategies to navigate this exact trap. Strategy 1, the sniper. This is the conservative, high probability mean reversion setup. We are waiting for the trap to spring. The trigger condition is a false breakout above 74.54 followed by a 60-minute candle close back below 74.45. That is the fakeout. The moment a 60-minute candle closes back inside the range after poking above the wall, you execute a short. The stop loss is tight, placed at 74.62. That is just above the wick of the false breakout. The logic is simple. If the market has the strength to stay above 74.54, we do not want to be short. Target 1 is the 20-period moving average on the 4-hour chart, currently projected near 74.15, giving you a crisp risk-reward ratio of 1 to 3. Target 2 is the structural support at 73.56. If price reaches target 1, move your stop to entry. This setup is voided if we see a clean, high-volume candle closing above 74.54 without any wick rejection. We need to see the market lie to the upside first. Let's see how aligned we are. Type your S&P 500 range for tomorrow in the comments now. Is it 73.56 to 74.54? Or are you seeing a breakout to 7,498? I'm reading them, and I want to see where the retail sentiment is clustered. Strategy 2, the active trader. This is for those who want to ride the momentum but respect the trap. We are looking for a pullback entry, a buy-the-dip setup with a mean reversion logic. You wait for a pullback to the 7,356 support zone, but you do not simply place a limit order. You wait for the price to test 73.56 and for the 1-hour RSI to show a bullish divergence or a sharp rejection candle. The entry is triggered when price reclaims 7,370 after bouncing from 73.56. Your stop loss goes at 73.44, which is just below the support cluster and the next support at 73.11. This gives your stop loss breathing room against liquidity sweeps. Target 1 is the retest of the 7,440 zone. Once target 1 is hit, you trail the stop aggressively to 7,400. Target 2 is the breakout to 74.98. The trailing stop rule is critical here. If the market turns before hitting 74.98, you ensure you lock in profit from the bounce instead of letting it round trip. Strategy 3, the aggressor. This is a high-risk counter-trend trap play for those who know how to lose small. The setup is based on the internal negative divergence I showed you earlier. We enter short immediately on a spike to 74.98, but only with a limit sell order. Never chase the print. We assume that 74.98 is the liquidity grab before a rug pull. The stop loss is incredibly tight, placed at 75.10. That is a 12-point stop. If we are wrong quickly and we are out. The target is a violent snap back to the 60-day moving average, targeting 73.11. This is a high risk-reward trade of approximately 1 to 15. Explicit warning. This is a fade of a raging bull breakout and has a low probability of working on the first test. Only for those who respect the stop loss and can handle a fast loss without emotional damage. The risk management pulse. Never risk more than 1 to 2% per trade, no positions through high-impact news events, and hard stops are non-negotiable, especially in an all-time high scenario where sell-offs are instant. We are at the close. If you remember one thing, it's this. The S&P 500 is trapped in a gamma vice between 74.54 and 73.56. The entire momentum of the next week will be defined by the resolution of this range. Tomorrow's focus is the retail sales data and the bond auction reaction. If bonds sell off, the trap at 7,454 activates. If yields drop, the blast to 74.98 is imminent. That if you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Check the end screen. I've mapped out the exact funding rate reset that will send crypto either melting up or crashing down, and it ties directly into what we just covered here. Smash like if this analysis gave you a clear plan for tomorrow's open. Subscribe and hit the bell for daily coverage of the liquidity tide. I'll see you in the next one.